Hello, traders. Gary Wagner here. 12:45 in Honolulu, 6:45 in New York. It is Monday, May the 10th, 2021, and this is the daily report for gold and silver. We have two trades ongoing right now, gold and copper. Gold did close up by about $6 today, and we did see a decline in copper. We'll talk about both in detail, but we will also put out a trade recommendation for gold that will go in the opening letter that we send out to you as a trade alert. You'll talk about it during the show, which will begin now. Traders, gold had a respectable performance today, currently fixed at $1836.40. That is a net gain of $5.10, or about 0.25% on the day. It has broken through some key levels of resistance that we'll speak about when we pull up a chart, but there are a couple of things that are noteworthy when we take a look at current pricing. The first thing is I draw your attention to the Japanese average or Heikin Ashi charts, and we can see that over the last 3 days, even though today was really a doji-like candle, because this type of chart is drawn from the midpoint as a fix to the open, you can see that we've got nice body size, no lower wicks, which tells us that the trend to the upside still contains major strength. On this first chart, I'm using an extended Fibonacci retracement that begins in March of 2020. Gold was at 1448. That is the bottom of the retracement, and it moves up to the all-time record high at 2088. I have also included one moving average, the long-term 200-day, because I believe that is where resistance is, and I have added an Elliott wave count. And when we look at the Elliott wave count, in essence, what we are looking at is the fact that we are in a final primary fifth wave. And what I mean by that is we can see our long wave 3, which began roughly in April, markets trading at approximately 1,500 and change, up to the record top. Then we had a multi-month, almost a multi-year correction, taking pricing back down to the first of two bottoms. And that concluded a fourth wave and began our fifth wave. Now, here's what I find interesting. When we look at the fractal count below the primary, what we see is a wave 1, 2, 3, 4, and we are, looks like, at the conclusion or very close to the conclusion of that fifth wave. If that is the case, that would mean that we would get some sort of an A, B, C correction following that. And that is why the studies that I'm currently presenting to you, I believe, are so critically important because of the following facts. We do have a harmonic. The harmonic is between the 200-day moving average and the 61.8% retracement. They come in roughly a couple of dollars apart. You can see this particular red line, that represents our 200-day. Our 61.8 represents this. And if we enlarge the chart, what we will see is that the current highs that come in are just at this particular price point. That tells me that we could be at a top anywhere between 1844 current high today and 1855, which is the 200-day moving average, which is why I am making the following recommendation. I think that our most prudent move, if we don't see tremendous follow-through at the current price point of 1855, that is our point to pull profits, because we are in at 1810. If we get out at 55, we score a pretty nice profit on that of $45. Even if we got out at 44, that would be a $35 or $3,500 per contract profit. So my recommendation is to actually put in a price order to exit the trade at 1853. That will go out as a official trade alert. Now, there was an article by the CFTC that suggested that a break above 1850 would bring in the large institutional hedge funds. And in fact, if that did occur, that could take gold much higher than the projected 1855 that I'm talking about, and I believe it would take it approximately to 1900. However, it seems more likely after the kind of tremendous rally that we have witnessed since the end of March, beginning of April, that we could at least see a pullback in this area, some sort of minor correction, and then a return to rally mode. Because when we look at this count, this is once again a fractal count. This 1, 2, 3, 4, 5 really means that we have hit wave 1 here. A correction would be a second wave right here, and then we would go into an extended third wave, and that could take gold easily to 1900 and above. And if that was the case and we pulled profits in this particular area, I would have no problems buying the breakout. Maintain your current long position and add an order to exit the trade as a limit order at 1853 or better. There was certainly profit taking that occurred when we look at copper. Now, copper traded to a new record high. We can see that on this daily chart at $4.87.5 per pound. It did close lower on the day, closing at $4.69 per pound. But traders realize we entered a long position much below this current price point because we are in at $4.55. We'll talk about copper in detail when we pull up our charts and our current exit strategy. Unquestionably, we saw copper retrace today, correct. It hit a new all-time record high above $4.87 a pound. It closed at $4.7160. We're in much below this at $4.55 per pound. And when you do the calculations in terms of contract size, I'm putting that on the board now, you'll see we have a substantial profit. Does that mean that we should exit the trade? My sense is that we are headed much higher. We're out in a July contract, and based upon that, we are looking for a pound of copper to go to roughly $5.30 per pound. We'll calculate what kind of profit that would mean also. But unless it breaks below any of these recent all-time highs, one coming in at 65, and then the other one, this is where we actually entered at 55, I don't have a problem with maintaining a long position. Personally, see that we have strong support at approximately 60, with major support at 66, 466 per pound, which is well below the low that was achieved. Maintain your current long copper position. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.